Welcome back. Is Section 12J of the Income Tax Act a good tool for stimulating entrepreneurship and the growth of small businesses in South Africa? Are venture capitalists and angel investors taking advantage of it? Joining us for the conversation is Ernest Mazansky. He's a tax director at Werksmans Attorneys. Ernest, thank you so much for making the time to join us. Let's start off with what exactly does Section 12J say in layman's terms?
In layman's terms, provided you have a venture capital company which meets very strict criteria both as to itself and to what it invests in, people investing in shares in a venture capital company, and that means subscribing for shares, not buying shares, subscribing for shares will get a tax deduction for their investments.
Is this proving to be an attractive enough tool to attract investors and angel investors, whatever the term we like to use for them, to actually go to using venture capital companies?
In South Africa?
Yeah.
I checked up yesterday. As of now, I think 5 companies have qualified and registered with SARS as a venture capital company. 2 of them in the one this month, one last month, one last year, and a couple before. And I think I'm not sure one has even closed down.
But this model has succeeded elsewhere, has it not?
Yeah.
And what would you say is restricting us from following that same path?
I can't say, I can't do a comparison because I've never really looked at what they've done, but elsewhere. But it's very restrictive. The rules are very tight, and it's very restrictive as to what can and can't be done. And also the amounts are small. I mean, for example, other than a junior mining company, certainly in the first 3 years, the venture capital company, if it invests in an underlying company, that company can't, after the investment, have assets more than 20 million rand. Now that's not a large sum of money to be running a business with. I mean, it sounds 20 million rand, to you, 20 million rand. But in terms of building an entrepreneur, that company can't have more than 20 million rand of assets after the investment. So we're really talking small companies here.
I mean, Ernest, this is a fairly new asset class in South Africa, right? I mean, I think one of the first companies to actually performed under this Section 12J was Growvest.
Yeah.
Now, it being an asset class in South Africa, I mean, what does that mean for investors?
I think it means for investors who've got some spare cash and who are ready to take a punt, I think it would be something that they might have a bit of fun with. They might consider it. I don't think it'll be a big part of their asset base. I mean, remember too that in broad terms, an investor could never hold more than 20% of a venture capital company because they won't get a tax deduction once they hit that level. That's in broad terms. It could be actually less than that. So it's really for a bunch of people who have got spare cash and who want to take a punt and have a bit of fun, and I think that's where they would.
So it's being seen as too risky by, say, pension funds or those larger institutional investors who...
Well, I don't think they would. I think it's too small, never mind too risky. And even they don't get a tax deduction. They're tax exempt, so they're not looking for a tax deduction.
This still, though, must be good news for the very small businesses that are looking for equity capital to come their way. How would one go about positioning their venture so that it is attractive to a venture capital company?
I don't think there's any shortage of companies looking for funds, and even companies with good stories looking for funds. I think the challenge is to find investors who put money into the venture capital company. That's the bigger challenge. People who will say, look, yes, it's only costing me 60 cents in the rand because I'm getting a 40% tax deduction. But it's still my 60 cents that's going in.
Right.
Okay, and I want to know that the underlying companies are worth it.
So perhaps we could argue that our venture capital and startup scene in this country is a bit too young for something like this to really have an effect.
It is young. In the traditional private equity space, they don't want startups and they don't want turnarounds. They already want successful companies. Here you're asking someone to come in on the ground. And that's,
Ultimately, how much should a venture capital company look to raise to start off, to kick off?
Well, if you think about it, assuming they were the initial investor and put the initial capital in, and the maximum is 20 million, okay, and I'm not saying they'll go that high. They could go anything between, say, 5 million and 20 million. And you cannot have more than 20% in any single company.
Entity,
okay, so just doing the numbers, you should be looking at least 50 million I guess, to become reasonably viable, and hopefully more than that if you want to become really successful.
From a regulatory point of view, how easy or difficult is it to set up a venture capital company in South Africa?
It's very easy because basically to register with SARS, you have to be firstly in good standing, and if you've got a brand new company, you're automatically in good standing. And you have to get a phase license. That's the biggest one. You've got to get a phase license. But basically, in fact, if you tick all those boxes, SARS must register you. They don't have a discretion. You go to them and they must register you as a venture capital company. It's up to you thereafter to make sure you stick to the laws.
Right.
Now, looking at this tax deduction, I think it goes up to about 40%.
Yeah.
You know, how does it work? Does an investor invest in a particular venture capital fund, and then therefore they can get the 40%?
Yeah, the venture capital fund, as you call it, which will really be always a company. It won't be any other sort of entity. It'll always be a company. It will issue shares to the investor and issue them with a certificate. And on the strength of that, I don't mean a share certificate, I mean a share certificate as well, but an investment certificate. And on the strength of that certificate, they can claim the cost of the investment as a tax deduction. An individual will be 40%, a trust will be 40%, company will be 28%.
Let's look at the type of small businesses that these venture capital funds are attracted to. Which sectors are we seeing the greatest appetite?
I don't know where they're going to. Probably tech is quite a sexy one.
Very interested in tech.
But there's certain things they're not allowed to go to.
Okay.
They can't go into immovable property, for example, unless they're a hotel keeper. They can't go into financing. They can't go into many types of services like legal and accounting and that sort of thing. They can't go into gambling, liquor, guns, ammunition, any of that, the sin type things. They're not allowed to go into that. But for the rest, it's really up to the market.
Yeah, Grovest has made it quite clear that they're going for technology, and within technology, they're very interested in mobile.
Yeah.
Mobile is set for some explosive growth, and there are a lot of companies locally working on that type of thing. I think you've seen the same.
I mean, looking at now at the moment, which sectors are sort of appealing and interesting to venture capitalists? I mean, apart from the whole tech boom, I think everyone wants to go into tech, but really I think there are opportunities elsewhere that we may be missing.
Look, as I said, there are only 5 of these, and only one that I really know about, which is Grovest as well. But so I really don't know where they're going, but I'm sure there are plenty of people who are hungry for their money.
Yeah. Let's look at a forecast before we come to you. I mean, 5, do you think that we're likely just to stumble along the same trajectory? Is there anything in the horizon that you think could change this and see a greater registration of these VCTs?
I'm not confident of that. I think that this was someone's dream at Treasury, and it got through, and I don't think there's a huge amount of support either at Treasury or SARS for this. And without a sort of white knight pushing this, I don't know if it's going to go anywhere.
Where should that support come from, and what kind of support should that be?
That support will have to come from in Treasury. I mean, obviously someone else can motivate it, but that support's got to come from inside Treasury more than anything else.
What do they need to do to get things going?
I think for a start, this 20 million rand limit is too small. I mean, that's really too small. And also it's unclear.
Why?
Because what happens, for example, if they invest and there's 20 million and the next day the company goes and takes on debt and acquires an assets of another 50 million? Have they breached the provision, or are they within the provision?
But what are the implications if that does happen? Do you then have to pull out as an investor? What happens then?
Yeah, if the venture capital company ceases to comply with the rules, it can have its status pulled.
Right.
And if it doesn't remedy it, then whatever the investors got as a tax deduction, they don't lose their tax deduction. But the company is then taxed on 125% of that. So if the investors took in put in R1 million, the company will be taxed on 1.25 million. So it gets quite hairy if you get it wrong.
Right.
Perhaps just to touch on a broader issue, if we're looking at tax incentives to ignite entrepreneurships and startups in South Africa, do you think enough is being done? Do we have those types of incentives in place in comparison to other countries which are spurring growth through these types of incentives?
I don't think it's possible to say that's what's spurring growth. I think it's possible to say that's facilitating a portion of it. Okay, tax incentives themselves are not going to do it. You need a whole range of other interventions, I think, or disinterventions. In other words, freeing up the market, freeing up the red tape, freeing up the blockages. I think that'll do far more for entrepreneurship than.
So you don't think tax incentives need to be revised
I don't think,
or focused on?
I'm not saying that, but I'm saying that's not the starting point. I think there's a.
Ernest, it sounds like we are back to how South Africa does things when it comes to policy formulation.
Yeah.
Someone somewhere in some corner cooks up this legislation and says, "Here, this is how things have to
it's not
happen
holistic.
from now on." Exactly. So, I mean, you are raising quite a number of, issues that the industry is not clear on or comfortable on. I mean, is there an industry voice that is having interactions with Treasury, with regulators, and saying, actually, we need clarity on these issues?
I don't know. Is SAFCA doing it?
Yeah.
Does SAFCA do it? The South African Venture Capital Association? I don't know if they do it. I have no idea. Don't know.
Let's look at where it has taken off. I mean, it sounds as if in South Africa we're not really getting much traction with these venture capital companies. But are there other markets where this has taken off phenomenally? And if there are, what are the underlying factors that enabled that takeoff to happen?
I'm not sure. I know they've had it in the UK, for example. And in fact, they've gone one step further there. I don't know if they still have it, but they used to give deductions to employees to invest in their own companies. Okay, but that wasn't venture capital companies. That was any employment instead. I don't know if they still have it. So, because they try to encourage employee ownership. In this country, we try to discourage employee ownership because we tax the hell out of employees who acquire shares in their companies.
Right.
So, again, it must have been successful, otherwise they wouldn't have imported it.
Yeah.
The question is, are we making it successful?
I think it comes back to the issue of, are we ready for such a mechanism? And from our discussion today and discussions with other leaders in venture capital, it doesn't seem that we really have a mature enough market just yet. This could be something that we need to re-look at a couple of years down the line.
Yeah, I mean, even trying to actually get people to talk to us about this issue has been an uphill battle. I think, again, we are back at trying to do things that even the regulators are not, themselves 100%, invested and committed into making these sort of things work. But I mean, I think from a perspective of a small business owner, I think, there is something there for them, but the point is they themselves don't know these things exist. And whose job is it to make sure that those small companies, apart from our show, whose job is it to make sure that those small businesses actually are aware that these sorts of things are out there for them, and how can they access them, how can they make use of them, and how can they sort of, take advantage of these things? Because ultimately, these are created and formulated to spur entrepreneurship, to get people to start businesses, get venture capitalists to support them. A venture capital company investing, I mean, what's the period? How long should they be invested in a particular company? And I mean, to invest in a particular company, you need to know what that industry, what that sector is, what the fundamentals are, so that you as an investor can play an active role in actually ensuring that you earn a return and you get your money back. How long is that? How long is that period of investment?
I don't know what. I guess if you take a line through the sort of typical private equity space, they'll be looking at roughly 7 years, to 5 to 7 years as an exit
So that is
strategy.
not prescribed in the Act?
It's not prescribed. It'll be a commercial decision.
Well, we've got you just on that, Thandi. Grover's objective is to achieve returns between 3 to 5 times in a 5 to 7 year time frame. So I think you'd be looking at 7 years and more.
Right. So before we write off venture capital companies altogether, let me just get your final comments, Ernest.
I think you hit it on the head about the regulatory, and no one's pushing it. And this is very common in South Africa with many of our tax incentives. The government writes it into the law, and then steps back and says to the private sector, you go market it. I mean, for example, these new SEZs, the special economic zone, who's
Right.
marketing it?
Yeah.
Okay, or you're just leaving it out to the private sector to market. No one actually goes and the headquarter company regime. They put it in to compete with Mauritius. No one's marketing it.
marketing
No
it,
one,
yeah.
and it's the same thing here. They bring it in. No one's marketing it, and it should be government who markets.